All right, welcome back. Quantum computing stocks coming under pressure again this week in the wake of Quantum Day. That's at NVIDIA's GTC event. Kate Rooney here with more details. Tell us more, Kate.
Hey, Scott. Yeah, so NVIDIA's CEO struck a really friendly tone with those quantum industry leaders on stage at GTC this week. He also walked back some of his public comments that tanked these stocks back in January. Jensen Huang had casually questioned back in January if quantum computers would be commercially viable in 15, maybe even 30 years. This week, he says he was surprised that those comments moved markets. He kind of joked that he didn't know many of them were publicly traded. That olive branch and that tone did nothing, though, to buoy these highly speculative stocks. They are lower today, down double digits on the week. Names like IonQ, Rigetti, D-Wave. There's some quantum ETFs lower as well. Huang did acknowledge he may be wrong about that 30-year timeline, but he didn't provide any sort of new estimate, and that disappointed some investors. As you can see, this technology has been touted as a game changer for everything from drug discovery to energy. But quantum, we should say, it is not ready for prime time. A lot of this is still very theoretical. It's happening in a lab for the most part. We've got a CNBC digital deep dive out today. It discusses all of this and what we're talking about when we even say quantum computing, quantum physics behind it, the challenges of scaling this technology. Check it out. You can see the QR code there. Scan that or go over to CNBC.com, Scott.
We'll do that. Kate, thank you. That's Kate Rooney. Our next guest says a bounce could be due for those very stocks. Let's bring in Eric Jackson, EMJ Capital founder and portfolio manager. Welcome back.
Great to see you.
You think this was a significant enough event to save these stocks from these declines that we've seen? And at bare minimum, I mean, the volatility has been head spinning.
It has. These things move plus or minus 10% on a given day, whether or not Jensen's shining a spotlight on the space or not. Taking a step back, though, this is really the only corner of tech that Jensen Huang, arguably the most important CEO in the world, decided to take 2 hours out of his GTC conference this week and basically focus on, to put together a quantum day with 3 panels, including folks from AWS and Microsoft Azure talking about the future of the space. I mean, and like Kate said, basically did a mea culpa for his January comments. So the fact that, this is still a microscopic space in terms of the size of these companies and their market caps in relation to a $3 trillion company like NVIDIA. But the fact that he's focused on this, he's setting up a quantum research lab in Boston. This is an important area. And when he talks about what are we going to be talking about next year at our quantum day and what evidence are we going to see and all that kind of stuff, that's very, very bullish.
I mean, I hear you when you talk about the mea culpa. The cynic in me says, come on, you're telling me the same CEO who 2 months ago said of these stocks, well, this is way off into the future. Let's not get crazy excited. I'm paraphrasing, obviously. And it caused those stocks to absolutely fall out of bed. All of a sudden now at their event talks them up, and we should view this as some significant change in the timeline of quantum computing? I mean, come on.
Well, I guess, why do it? If his goal, Scott, was to crush these guys out of existence, why do it? Why invite them up? Why have them on? When I was chatting with you after those comments in January about it, I said it was a little curious to me because, as great as NVIDIA is, it still comes from a classical computing framework in terms of how it's developed. GPUs are obviously the most advanced version of that classical computing framework, but quantum computing is sort of the next step. So inherently, it's a threat to NVIDIA, and that's why keep your enemies closer. I think he's wanting to study the space. He's wanting to know kind of like how can we be involved in this in case there is this massive shift as sort of like a next generation step for AI and GPUs down the road. So if he was just wanting to put them out of existence, why bother to partner with them? Why bother to have? No,
I don't think he wanted to put them out of existence. I think it was a reasonably innocuous comment originally, just speaking truth. Like, okay, this is going to be amazing, but it's years off. And the stock's plummeted. And now he is out suggesting that, well, maybe it's not going to be so far in the future. I mean, you don't find anything interesting about that?
Yeah, no, I listen to his comments the way that I would listen and parse the words of a politician. And sometimes, what they're not saying
Well,
is,
good
or
luck with
how they're
that.
saying it is as important, right?
Yeah, but I'm saying, I mean, if that's what you're going to analogize it to, okay, I mean that's a little difficult.
Well, here's what I think. He was, what NVIDIA is really good at is solving big, complex, multivariate problems, taking tons and tons of data and throwing at it. What quantum is good at now, and maybe it'll be different in 15 to 30 years, but quantum is really good at solving very limited, focused problems. You might say that's not as important. There's not as much money in that, and that's why NVIDIA is a $3 trillion company. But an important, limited, focused, narrow problem is, for example, cracking into RSA level security or SHA-256 security that protects all crypto wallets around the world. Like we just saw with a $1.6 billion hack recently of Ethereum on one of the brokers. So that's what that's focused on. I mean, Commerce Secretary Lutnick said yesterday, the day before on the All In podcast, we have to mandate post-quantum security cryptography to prevent a quantum hack from a foreign nefarious person or state that's trying to crack into us. So that's a limited problem, very profitable, very important, but it's not a 15 to 20 year replicating exactly all these big problems that NVIDIA is solving. I think that's where you can have your cake and eat it too. You can be long NVIDIA and you can be long some of these quantum names.
Okay. Oh, I appreciate it, Eric. We'll continue the conversation. I got to bounce. I have breaking news that I need to get to on the IPO front. Our Leslie Picker has details for us. What do we know, Les?
Hey, Scott. Yeah, StubHub officially filing to go public. This was a closely watched moment for the more than 20-year-old company. The marketplace for ticket sales planning to list its shares on the NYSE, and I'm told by a person close to the matter that it is targeting a debut in April. The ticker will be STUB, S-T-U-B. StubHub initially planned to go public last year with a valuation around $16.5 billion, although it punted the deal amid that big dearth in offerings that we saw in 2024. Now, having full year 2024 numbers may have actually been beneficial here, given fourth quarter revenue of about $500 million surged 60% year over year. Gross merchandise sales comprising total value, dollar value by buyers for ticket transactions and fulfillment, those jumped 47% to $2.5 billion in Q4. Lately, the company has actually been investing in what it calls original issuance, which means working with content rights owners, performers, a team, an artist, etc., rather than secondary sales, which is what the marketplace is known for. JP Morgan, Goldman Sachs managing the offering. Can I continue digging through this one, and I'll send it back to you in the meantime, Scott.
All right, Leslie, thank you for that. Leslie Picker up next. Ed Yardeni is back with us. We get his first reaction to the Fed meeting this week, the increased market volatility, where he thinks we are going from here. Next.
Join Jim.
All right, we are back. President Trump saying today, as we discussed earlier, there will be, quote, flexibility on his reciprocal tariff plan, which is set to go into effect on April 2nd. My next guest still sees those tariffs as a big risk to the market. Let's bring in Ed Yardeni of Yardeni Research. Good to have you back. Tell us more.
Thank you. Well, I guess if the president's going to be flexible, I have to be flexible. I think we all have to be flexible on where these where this tariff issue is going to take us. April 2nd is Liberation Day. It's according to the president. It's when we're going to have all these reciprocal tariffs. And maybe after all, he is looking at the market. You know, he kind of has led us to believe that the market doesn't really matter that much to him anymore. But I think today's comment about his flexibility on reciprocal tariffs may be him kind of watching what's going on CNBC.
Doesn't all this just add to the uncertainty, though? Right? We're asking ourselves as investors the question, does he care about the market? Does he not care? I thought he did. Well, maybe he doesn't. Are we going into a recession? I don't know. They haven't talked us out of it. Are they telegraphing us into one?
Yeah, it's pretty wild. I mean, you need a neck brace to deal with this environment. But all in all, it's kind of starting to feel to me like the market may be trying to bottom out here. Sentiment is extremely bearish. And typically when sentiment is this bearish, you make a bottom. But the reason you do that is that all the reasons for bearishness lead to a Fed put. And I think you mentioned that I might comment on the Fed here. And I think the Fed did, in fact, indicate that the Fed put is still very much available. It's on standby. The Fed said that, again, they're in no hurry to lower interest rates. They didn't say they're in no hurry to do anything. They didn't say they're in no hurry to raise rates. So I view their position as inherently dovish. They're looking to lower rates. And if we get into trouble, they'll do that. Maybe that will make the bottom. And maybe that'll be sometime in the spring. But meanwhile, my base case remains the same. I think the economy is going to prove to be remarkably resilient. I'm expecting to see some real good bounce backs in retail sales in March and April. I think weather had a lot to do with the weakness in January especially, but also February. So I'm counting on the economy to show its strength as it has for the past 3 years.
All right. Good weekend, Ed. We'll see you soon. I appreciate your time as always, Ed
You
Yardeni.
too, Scott. Thank you.
Yep, you bet. Up next, we track the biggest movers into this Friday close. Pippa Stevens is standing by with that. Hey, Pip.
Hey, Scott. Well, one stock is taking flight after a vote of confidence from the U.S. government. We've got the name to watch coming up next.
We're about 10 from the bell. Back to Pippa Stevens now for the stocks that she's watching. Tell us what you see, Pippa.
Well, Scott, Boeing is getting a big boost after beating out rival Lockheed Martin on a multi-billion-dollar contract to build the next-generation fighter jet for the U.S. military. President Trump announcing the decision alongside Defense Secretary Pete Hegseth today. Lockheed Martin selling off on the news while Boeing shares are up 4%. And shares of Nucor are falling after the steelmaker forecast lower than expected profits as a weaker steel pricing environment weighs on sales. However, the stock is moving off session lows as President Trump indicates there might be some flexibility on upcoming tariffs. Scott?
All right, thank you. Pippa Stevens still ahead. Nike shares hitting a 52-week low after weak guidance today. That stock is the biggest loser in the Dow right now. We break down the details behind the move next.
U.S. business.
All right, straight ahead, the Nasdaq's gone positive, and the S&P is trying to snap a 4-week losing streak. We count you down to the bells in the zone next. Closing Bell Market Zone, CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. And Courtney Reagan on Nike's sales warning. Court, we start with you. A big story today in these markets.
Yeah, of course. I mean, Nike down really notably in reaction to mainly the commentary about the time it's going to take to return to growth. And analysts are worried about sales declines in Greater China more specifically, though, too. Potentially maybe a bigger issue than previously presumed for Nike and then maybe writ large for more retail and consumer businesses there. New CEO Elliott Hill sharing some evidence in his Win Now strategy. He's saying it's working, but it's going to take several quarters to reset the inventory, regain margin growth. They're clearing through that with a lot of clearance sales. And while Nike is a key vendor for other retailers as a wholesale partner like Dick's Sporting Goods and Foot Locker, shares there actually higher and let's call it flat respectively for Foot Locker today. Further, the XRT retail ETF slightly higher on the session. That's outperforming the broader indices into the close here, up about 2% for the week, also better than the major indices performance over that time. So investors, Scott, I think seeming to read into Nike's results is more of a company-specific issue. And I have to admit, I'm a little bit surprised about the reaction today to Nike shares. Even after hearing what we heard, we knew that they're going through this transformation under Elliott Hill. I don't think anyone thought that it was going to be quick. Maybe they thought it would be quicker. But not entirely surprising from those of us that follow it more closely. Back over to you.
Still a guilty before proven innocent stock, I suppose.
Fair.
Court, thank you very much for that. Courtney Reagan. Speaking of, Mike Santoli's with us. I mean, the market clearly is still that.
Yeah.
I'm just not sure what you do with the Nike and the FedEx versus an S&P that's already fallen 10%.
Yeah. Look, I think the broad market didn't do anything else this week to kind of further compromise its status, its legal status, so to speak. But the Nike and FedEx news and the reactions to them, I do think keeps everybody on high alert. We're in the final week, basically, of the quarter. It's hard to see things that are going to make you want to lift earnings estimates in the near term, but we continue to hunt for the moment of peak uncertainty, of peak policy uncertainty. Everybody knows that's the time you're supposed to buy. And maybe today's action with a little minor hint of flexibility on tariffs is activating that impulse to say, yep, we know. Nobody has a clear vision of how this plays out, but we've been sort of stewing in it for so long that maybe, we can figure out whether it's priced in or not. By the way, not bad that the S&P is going to go positive for the week. 5-week losing streaks are very rare and usually happen in very treacherous markets.
Well, we'll finish with a flurry. Mike, thanks. Great weekend to you. That's Mike Santoli. NASDAQ positive by 0.5%, making a move here into the close, as is the S&P. Dow looks green now, too. We'll see how things settle. I'll see you on the other side of the weekend, which I hope you have a great one into OT.
Well, that's the end of regulations. Xylem ringing the closing bell at the New York Stock Exchange. Microsoft doing the honors at the NASDAQ, and stocks closing at the highs. After a calmer tone on tariffs from President Trump helped pull stocks off their lows mid-session, the Dow, the S&P 500, and the NASDAQ all finishing with gains for the week. That's the scorecard on Wall Street, but the action's just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Ford.
Now, coming up this hour, the bull case for NVIDIA. We're going to hear from one analyst who says the company's developer conference has convinced him to be even more bullish on the company for the long term, even as that stock turns in another losing week.
Plus, details on the fighter jet contract dogfight that sent Boeing and Lockheed Martin in opposite directions today.
And energy trader Bill Perkins tells us why he says natural gas is currently at a crossroads and how to play it.
Well, let's get straight to the market action with Citi Research Director Drew Pettit and Ariel Investments Vice Chairman Charlie Babrinskoy. It's great to have you both on here today. And Drew, I'll start with you because I'm looking at your notes and you seem pretty constructive on stocks here, given the drawdown we've seen in recent weeks.
Yeah, look, I think the message we're trying to send is stay the course. When we were talking about the first half of this year in December, it was about first half volatility. And then all of a sudden, when you get it in policy uncertainty, which a lot of people were talking about, then do you really need to freak out or not? Look, we understand there's still some uncertainty ahead around tariffs and the impact on earnings. But at these levels, let's call it 5,600 today, feel a lot better than we did when we were trading, north of 6,000.
Charlie, do you feel a lot better, especially as Mike Santoli put it just a few moments ago, we're in the midst of peak policy uncertainty?
Yeah, this may surprise you, Morgan. I get accused of being a perma bull. I've been pretty bullish on the economy for 4, 5, 6 years, and I'm cautious here. I think people are familiar with history, know how dangerous tariffs are. It is not an exaggeration to say that the Great Depression was caused by Smoot-Hawley and a trade war. Tariffs, the fundamental document in capitalism is The Wealth of Nations by Adam Smith, written in 1776, which made the argument for free trade. It is a foundation of our economy, the world's economy, and we are playing with fire. I think this is very still dangerous. I hope people are right who think that Trump is bluffing, but if he's not, and he's really going to put these tariffs on, it's going to be very painful and more painful than what's reflected in the market right now.
So, Drew, is this mainly a question of whether or not you think a recession is likely here?
I think it's how deep and how long. You know, we've said this looking at the data over history is if you really want to know where the S&P was going in the 80s, you know, figure out where GDP is going. If you want to figure out where it's going today, it's a little bit more about secular trends, not to completely divorce the two from one another. But look, I just think, yeah, recession is going to hurt the growth side of the market, but there's still some secular tailwinds. There's still a lot of focus on productivity. And I think there's a lot of levers companies are going to pull, and they're not just going to take tariffs and changes, just kind of lying down, sitting back. So to us, look, I'm probably more glass half full than Charlie is here. But at the end of the day, yeah, tariffs are a negative. We really do need to get past that if we want serious upside.
Charlie, on top of that, student loan defaults are starting to hit consumer credit scores. What's the impact, you think, of that going to be, and how should investors position if they're concerned about it?
I think you got to broaden that. I think it's not just student loans. I think it is the consumer got big payments from Washington in the COVID years, and they have gotten big payments that are now slowing down. And I think Brian Moynihan said something that surprised me. He said the consumer is in better shape than people think. I don't see that. In the portfolio companies that we talk to, we think the consumer is okay. There's obviously very low unemployment, but the consumer is feeling some strain here. And so you're going to see it with some higher student loan defaults. We're going to see it with credit card payments being a little weaker. I think the consumer is not in great shape.
So, Charlie, I want to talk to you about a name that you have owned for a while. You've recommended on the show, MSGS. What do you think now that we saw a record sale for the Boston Celtics earlier this week, which actually sent shares of MSGS higher? We talk a lot about fixed assets or assets that are not tied to the public markets. Sports does increasingly seem to be one of those.
You're exactly right, Morgan. This is the kind of name that we want to buy in this environment. The sports teams, the TV revenue is not going to head down. The people that buy suites at Madison Square Garden are not people that are going to feel some of the effects that I talked about on the consumer. So we think the NBA is in very good shape. Remember that Madison Square Garden Sports owns not only the Knicks, but the Rangers as well. And the stock is now trading for less than the price of what the Celtics were sold for by themselves. So you put this all together, and we think that MSGS is selling for 40 to 50% below what it's actually worth. Now, we got to get Mr. Dolan to consider a sale, and that's not going to be easy, but the value is there.
Drew, where do you go in your portfolio to sort of defend yourself against the things you expect?
Look, it's a barbell. Actually, it's funny. What Charlie's talking about is kind of a secular trend in the consumer, right? So we like some of the secular themes on the cyclical side where we're seeing some early improvement in some of the short cycle. And I like to pair that with growth at a reasonable price. So look, we're not jumping into the deep end here and just buying the NASDAQ outright. But look, I think you get a lot of interesting pharma, communication services, that play really nicely to that GARP side of the portfolio.
All right, Drew Pettit and Charlie Babrinskoi, thanks for kicking off the hour with us.
Thanks, Morgan.
Major averages higher on the day and on the week, with the exception perhaps of the Russell 2000. Well, another name that moved higher today. This was a big win today for Boeing, as President Trump announced from the Oval Office that the aerospace giant would build the Air Force's next generation air dominance NGAD aircraft. Here's a rendering of the newly named F-47. It's the first public image for the super secretive program that has apparently been flying prototypes for the past several years. The F-47 will be the world's first 6th-gen fighter jet, stealthy, crewed, so people will be on board, set to replace the F-22 in the next decade. For Boeing, this is a huge coup. After years of setbacks on other government programs, Boeing's phasing out the FA-18 for the Navy. It has been investing billions in its St. Louis factory as it has competed for this contract. The company saying in a statement that, quote, it made the most significant investment in the history of our defense business in preparation for this mission. Now, the F-47 program itself, as of now, it's said to be worth about $20 billion in contracts over the next 5 years. And the program overall expected to cost hundreds of billions of dollars. With limited info so far, at least what we have publicly, Cowen estimates that total program value could be around $240 billion. But a big win for Boeing is also a big loss for rival Lockheed Martin. So this knocks Lockheed out of the running for any of the 6th-gen fighter programs under development after the Navy down-selected to Boeing and Northrop Grumman for its FA-XX competition, its own NGAD competition just earlier this month. Now, Lockheed telling me it is, quote, committed to advancing the state of the art in air dominance to ensure America has the most revolutionary systems to counter the rapidly evolving threat environment. That while disappointed with this outcome, we, Lockheed, are confident we delivered a competitive solution. We will await further discussions with the U.S. Air Force. Now, it's unclear whether Lockheed will protest this decision. That tends to happen with big contract outcomes like this. We'll see. Meantime, there are other active competitions that are tied to this broader NGAD strategy as well. GE Aerospace and RTX are competing on the engine for this aircraft, and startup Anduril Industries and General Atomics are competing on the Collaborative Combat Aircraft, the CCA, which is worth about $9 billion over the next few years on its own. CCA, this is the drone wingman that will fly missions alongside the F-47 as well as F-35 stealthy fighter jets. But you can see, John, shares of Lockheed Martin finished down about 5.5% today. Boeing up about 3%, though, off the highs we saw earlier in the session.
How much of this defense environment is zero sum? You either win or you lose, especially as all kinds of expenses coming under scrutiny in the federal government.
Typically, big programs like this, especially aircraft programs like this, it is usually just one winner for a competition like this. That being said, in general, and we saw everything sort of come off the lows here in the afternoon, but once again, for the most part, you saw defense names under pressure today. They've been under pressure really since the election outcome. And the reason is because of all the focus on DOGE, and we know Elon Musk was visiting the Pentagon today. We know the Defense Secretary Hegseth has been cutting certain programs, another, call it $500 million that was announced yesterday. And so defense stocks have been selling off. What I would say, and I was talking to Tony Bancroft over at Gabelli Funds. He runs their aerospace and defense investments over there. He was talking about this, too, is that the market seems to be missing it here because case in point, with this NGAD award today and some of the other big awards that are expected to come or big programs that are expected to materialize, like Golden Dome, which is going to be tens, if not hundreds of billions of dollars to build out. This is about reallocating defense dollars, which will ultimately be good for the defense sector, and cutting them away from things that are not necessarily about modernizing the military. So overall, this could actually be bullish even as the stocks sell off.
Okay, we'll see. Well, for now, let's turn to senior markets commentator Mike Santoli for a look at key levels to watch if you're going to believe this rebound. Mike?
Yeah, John, kind of a mixed conclusion after this week's action. I don't think the S&P 500 did anything in particular to compromise the notion that last week saw a pretty credible low on a tactical basis, but we didn't get escape velocity by any means. Kind of flattish on a week-to-date basis, down from Monday's rally. And we're also at this level from right back here I've been talking about for a while. That's the mid-July high. It was exactly 56.67. We're still looking up at the 200-day moving average. Now, it's okay to spend, a couple, 3 weeks maybe or more below that level, as long as you don't really lose too much more ground. In the last 10 years or so, 10% corrections, which is what we just had, about half of them go significantly further than that, and half of them you find some traction there. Now, take a look at some seasonal patterns. It's supposed to be a better time of year after mid-March for the S&P 500, seasonally speaking, but in years following a 20% up year before, which we had in 2024, there has been some tax season related selling. At least that's the way it looks historically, is what's impacting the market there in that time. If it was less than a 20% up year, you see it's a little smoother path higher. I would say, though, maybe there's a difference this year because we've been selling since February, right? You're down since February 19th in the market. So maybe we sort of preloaded some of that cash raising for capital gains purposes. This, by the way, from 314 Research, this analysis.
But the big question, Mike, isn't it, is April 2nd. Yes. Are we surprised one way or another, not only with what the president does tariff-wise, but how other countries respond?
Without a doubt. So I don't think anybody is sitting here and saying, we know exactly how this goes from here. It's much more about, has the market kind of tensed up enough in advance of this that we can absorb whatever might come on April 2nd? Who knows? Maybe there's room for upside surprise in terms of maybe not having such a severe tariff response. That maybe was the market message from today. And then finally figure out some equilibrium beyond that. So I'm not suggesting, hey, stop worrying. Worry helps, at least to get people having more realistic expectations for the market.
All right. Mike Santoli, thank you. We'll see you later this hour. When we come back, energy trader Bill Perkins tells us why he thinks natural gas is at an inflection point and how Trump energy policy could impact the whole commodity complex.
Plus, the NASDAQ managed to eke out gains this week, though NVIDIA sat out the rally, even after a number of announcements at its developer conference. But one analyst says the long-term bull case became clearer this week. We'll hear why when Overtime comes back in 2.
Welcome back. Oil and natural gas moved in opposite directions this week. Oil posting gains on the back of sanctions on Iran and a plan from OPEC Plus members to cut output. Meanwhile, nat gas posted its second straight weekly loss due to a surprise storage build. So joining us now is Bill Perkins from Skylar Capital Management. Bill, it's great to have you on. You say nat gas is at an inflection point. Why? What do you mean?
Well, last year we had the producers curtailing production because of low prices, and they're preaching capital discipline and that they're going to need higher prices to invest in natural gas. But they are turning on wells that they've turned off, so we have higher supply. But what's been going on in the Gulf Coast is we've been exporting a lot more LNG, particularly around the Henry Hub, about 3.8 BCF a day and rising. Venture Global came out and said that they found efficiency gains of 40%. And so there's kind of this tug of war on whether or not Henry Hub prices are more related to the international market than they are to domestic pricing.
That's certainly a shift. I'm curious what you think energy policy is going to mean for this market and for the energy complex writ large. Because on the one hand, and we saw it with President Trump meeting with oil and gas executives at the White House this week, the whole drill, baby, drill ethos. On the other, you've got all the trade and tariff dynamics, and you also have geopolitical cross currents, including a possible ceasefire in Ukraine and Russian energy products coming back on the market.
Yeah, it's a mess to try and untangle. I think in the longer term, we can see rising production as they work through the regulations and the permitting processes that slow down development. I think that's a longer term solution, not an immediate solution. I think in the immediate term, we have export authorizations for LNG. Now, it takes a while to build an existing LNG plant, or I'm sorry, a new LNG plant, but to debottleneck one and to get more LNG out of this country, that can happen rather quickly. And so I think the kind of the permissive attitude towards energy infrastructure is slightly bullish in the short term and bearish in the long term.
Bill, what's the likely impact of a global trade war on energy? Does it lower demand?
Yeah, that's definitely the bearish. You know, you're seeing that in crude. Crude gets spooked. Anytime we're talking tariffs, trade wars, et cetera, that generally isn't good for global GDP, which isn't good for energy use. I think global GDP and energy use are synonymous. And so you can see pressure from the macro strats, exiting energy or exiting anything where we're looking at a recession or kind of a slowdown in the global economy. That is a spooky bearish fact out there.
So if that's the expectation, what's the surprise that ruins that trade? What are the factors that could cause things to go the other way?
Well, I mean, if you look over to Europe, the prices are in the teens, right? They're $13, $15, right? And so, and you look over at Henry Hub, we're talking $4. And so that arb is pretty large. And so as these export facilities ramp up, do domestic prices in the Northeast or Chicago matter? Is there even enough infrastructure to get the gas from where the gas is produced to where it's going? And so that's kind of the tug of war. If you look at your total U.S. balances, they look fine. But if you look in the South Central or particularly Eastern Louisiana or around the hub, things look extremely tight. And there's a debate on whether it's too tight or short when the cooling season starts. We're going to find out very soon whether or not that's true. If it is too tight, there could be a violent move upward. If it's not and it's loose, it could be under pressure given where we are headed in stocks.
I realize this is a longer term dynamic. You just touched on the fact that it is. But are we going to see more infrastructure built out for some of these? I think about Marcellus Shale and how landlocked some of that gas is when you're here or where I live in New York State, and utility bills continue to move higher despite the fact that it's basically in your backyard. Do we start to see more of this infrastructure build out in general domestically?
Yeah, definitely. We're going to see more build up. Where it depends on the state. I think New York State is very anti-growth, very anti-development, particularly in the Northeast. So it's very hard to get pipeline projects. There's a ban on drilling in the Marcellus. The Marcellus we're not even drilling in the true Marcellus. That's the upstate New York part. But in Texas, moving the Permian gas across states into Louisiana, over time, we're going to see a lot more energy infrastructure built in certain areas that are a little bit more, let's say, friendly to energy development. And in areas where the states are particularly harsh on energy development, it's going to be a longer road.
Okay. Bill Perkins, great to have you on. Great to see you. Thank you.
Thanks for having me.
Coming up, retail on sale. The consumer discretionary sector is pacing for major losses this month, with Nike the latest name to crack after warning about falling sales. We're going to talk about the names that could be worth a look at discounted prices.
And later, we'll hear from the CEO of satellite imagery company Planet Labs, whose stock sank double digits today following last night's earnings results.
CNBC.
Welcome back to Overtime. Nike falling 5% today, the worst performer in the Dow, on the heels of last night's earnings report here on Overtime, where it warned about a drop in sales as tariffs and consumer confidence fuel uncertainty in retail. With Lululemon set to report next week, let's get the read on retail and the consumer with Simeon Siegel, Managing Director at BMO. Simeon, happy Friday. Good to see you. Is Nike management just kitchen sinking it here? Uncertain macro, maybe trying to protect the credibility of a new CEO?
That would be nice. I think, hey, John, good to see you. I think the uncertainty word, I think that's the word, and I think that's true across retail. We'll see it with Lulu. We've seen it for the last several weeks. I think if you and I were able to say this was it, we have the light at the end of the tunnel, I think Nike would have closed up higher. I think that right now there is a lot of hope. I think there's still a little bit of confusion. I think once we can create clarity, that's when you'll see people jump in.
What's the likelihood that we get a similar message from Lululemon?
So different scenarios. As you say, it's a new CEO. We have a problem of overextension. Lulu right now is still questioning right now, are they in growth mode, or are they not? And so I think what happens with Lulu is there's product conversations, there's competitive conversations. And I think what you and I are going to find out increasingly each quarter is where do they fit on that maturity curve? International should be fine. The question is going to be the difference between, and it's going to sound silly, for North America, for America, the difference between a positive 1% to 2% growth and a negative could actually have severe ramifications. And so there's general negativity around Lululemon right now, not because the brand isn't a strong brand, but because perhaps it's overextended, and we're going to find out that there's room to give back.
How much of this is a reflection on the state of the consumer, particularly here in the U.S., versus the fact that there's just a lot more competition in the market, especially when you're talking about something like athleisure?
So, Morgan, I think it's a great question. I think that the reality is if we were to rewind and say, okay, we're talking about Q4 earnings right now, which sounds funny and backwards looking, but that's what it was. And so if we were to look back at the Q4 earnings reporters, everyone feels like they were disastrous, because if you look at the market has been disastrous. Most holiday reporters actually were good. Most holiday reporters saw revenue grow. They saw margin grow. It was the guidance. It was this macro uncertainty. It was the thoughts of caution for the future that got people all concerned, not the actual spending. And so I think that the U.S. consumer, clearly there's delineation, clearly there's different areas, but I think maybe they're getting a little bit worse than they actually are when I think we're framing them worse than they actually are. People are still spending. Now they're choosing where to spend, and there's winners and losers instead of like rising tide lifting all boats. But we're finding in every subsector there's a winner and there's a loser, and that's not an unhealthy thing. That's market share.
It's also interesting, and you're touching on it, and we saw it even this week with some of the names that reported, whether it was Nike last night or Five Below the day before, the fact that a lot of these retailers and apparel brands are factoring in possible tariff impacts, and we don't actually know how any of that's going to play out either. So there could be potentially room for upside surprise, potentially. So in light of that, and in light of what you're saying, what would you be buying right now?
So I think the question now is, how dirty are you willing to get? So do we want something comfortable? Do we want a TJX where we need to spend up, but we know that there's not going to be a whole lot of surprise factor, and that you're just comfortable, sleep easy at night? That's bucket number one. So that's kind of my right side of the barbell or left side of the barbell, whichever way the screen shows me on. The other side, the dirtier side, the more interesting side, perhaps, would be Capri. And you and I have talked about this one in the past. What's so fascinating to me about Capri, which owns Michael Kors, Versace, and Jimmy Choo right now, is there's a market cap of around $2.5 billion and net debt of around 1.1. They are talking about potentially, or they are not, the media is talking about potentially them monetizing Versace and or Jimmy Choo, which could solve this net debt problem immediately. But even if they don't, Michael Kors generates a lot of cash. I think there's a really interesting dynamic where you look at the Michael Kors business, which looks like it's been underperforming and tied into all of the macro conversations we're having now, but you layer that in with a balance sheet opportunity that makes the stock particularly interesting. And so in a world where the sun comes out and people are willing to bid again, I think there's a lot in retail that has seen meaningful collapse that then people might get a little bit more comfortable. And so that's digging a little bit more in the dislocation versus the TJX, which is the comfortable, safe place. Okay, so that goes to maybe put a finer point on that. Are you saying the mainstream consumer, if you're taking a flyer, that's a stock that you would pick for the mainstream as opposed to high luxury or a discounter? So sure, I mean, that's where they fit. I think the beauty of this is there's winners in luxury, there's losers in luxury, there's winners in both of these areas, and there's revenue growers. And so for me, I'm thinking about this in the context of retailers that have fallen, retailers that have a compelling valuation with a really interesting balance sheet kicker. If the fact that I've got almost half of my market cap in net debt means my enterprise value is too high, that will be fixed. That'll create interesting stock market opportunity. If I just look across where are the retailers that have gotten knocked down, Michael Kors is absolutely one of them. And very much to your point, that is not when we talk about ultra luxury. So appealing to a different consumer.
All right. Simeon Siegel, thank you.
Good to see you guys.
Good to see you. Yeah. And by the way, cue the QR code. You can see that too, because it leads in perfectly to the latest installment of my On the Other Hand newsletter. This week's debate, are consumers tapped out now that consumer debt has hit $5 trillion? So you can scan that code on your screen or type in cnbc.com/OTOH to join the conversation.
Well, after the break, the S word on everybody's mind on Wall Street and at the Fed.
Tariffs raise prices and reduce output. So that's a stagflationary impulse, which is different from saying this is stagflation.
All right, well, we're going to look at what the data says about the stagflation equation when overtime returns.
Let's get a CNBC News update with Pippa Stevens. Pippa.
Hey, John. Colombia is reportedly giving up the battle over $400 million in federal funding with the Trump administration. The Wall Street Journal reports the Ivy League university is giving in to demands, including an agreement to appoint someone with broad authority to oversee some of its international studies programs. The White House pulled the funding earlier this month over concerns the school isn't adequately protecting Jewish students. Hundreds of the SEC staff have agreed to take President Trump's buyout offer amid efforts to trim the federal workforce. Sources tell Reuters more than 600 people have agreed since January. The SEC declined to comment. And a British Airways plane landed this afternoon at London's Heathrow Airport, the first of several to do so in about 18 hours after a fire caused a power outage that shut down operations at the airport, affecting thousands of flights. The airport's chief executive said Heathrow would be working at, quote, 100% by Saturday. Morgan, back to you.
Pippa Stevens, thank you. One of the reasons the market has been under pressure is because of concerns over growth and inflation. So let's bring back Mike Santoli for a look at the risks that the Fed is watching. Mike.
Yeah, so it's not really quiet on either of those fronts, the growth side or the inflation side. And this is really an illustration of that from within the Federal Open Markets Committee of the Federal Reserve, the policymaking group. Now, they all asked for their projections, right, around what GDP is going to be and what inflation is likely to be. And then along with that, they have something in there that says which direction is the greatest risk to your forecast. So what you're seeing right here is for inflation, essentially the entire committee saying that the risk is to the upside of core inflation relative to what they put down on paper for the end of this year. And in similarly, or mirror image, that almost everyone is saying the risk to their real GDP forecast is to the downside. So this is what gives that feel of things moving in a stagflationary direction, even though the situation we're in right now could not be really described at that, with 4% unemployment and 2.5% inflation. So I do think this sort of encapsulates what the overall markets have been dealing with here. I do want to point out, though, look at the prior time we had this kind of wide gap, right? That was like 2022, when everyone thought we needed a recession to kill inflation. It didn't happen that way. And so the economy managed to be a little more resilient in both on both fronts than was expected.
I have to tell you, I think Steve Leisman would be proud of you for pulling this out of the Fed's forecasts this week.
Proud of me for a change, you mean? Is that?
Yeah, just because I know he pays attention to this when
Yeah.
it comes to the dot plot and the forecasts and sort of where everything's headed and why.
That's right.
And it does seem like it's very reflective of the trade wars as they're playing out and given what we know from a limited certainty place.
Exactly. And, you know, it's not unrelated that we had this little bit of a soft start to the year, and then it got compounded by the possibility of very aggressive tariffs that might undermine whatever momentum we did have. But I do think it also is illustrative of the way people are essentially kind of disclaiming any conviction in their outlook. And Fed Chair Powell said something like that, too. So I'll channel Steve Leisman. One of his favorite sayings is, if you're not confused, you're not paying attention.
All right, Mike Santoli, thank you. Well, shares of imaging satellites maker Planet Labs sinking after a weaker than expected first quarter outlook. Up next, CEO Will Marshall breaks down the results and the role that Gen AI is having on his business. That's in an exclusive interview.
Plus, NVIDIA shares now lower for 4 out of the last 5 weeks. But later we'll hear from a top technology analyst who's even more long-term bullish on the company after attending its developer conference. We'll be right back.